You can lose thousands on ETFs without even knowing it. ETFs aren't complicated, but the way people use them is costing them serious money. I've helped millions improve their finances, and I'll show you the 5 traps beginners fall into and exactly how to sidestep them. Let's start with the sneakiest one. Expense ratios silently eat your returns over decades. You don't get a bill, but every year a percentage of your investment disappears into fund management costs. Here's what that looks like in real numbers. Let's say you invest $10,000 for 30 years. If you're in an ETF with a 1% expense ratio, your money will grow to $175,000. But if you pick an ETF with a 0.03% expense ratio, it'll grow into $227,000. It's the same investment and timeline, but you end up with $52,000 more. The gold standard ETFs keep fees under 0.05%. VOO tracks the S&P 500 and VTI tracks the entire US stock market, both at just 0.03%. This gives you massive diversification for almost nothing. Here's the fix. Check the expense ratio before you buy. Anything over 0.2% needs a really good reason, since most of the time you're just paying extra for nothing. But even low-cost ETFs can cost you if you make this next mistake. I'm sure you think you're diversified because you own 3 different ETFs, but here's what's actually happening. All 3 hold Apple, Microsoft, and Amazon. This is called ETF overlap, and beginners do it all the time. They'll buy an S&P 500 fund, then add a tech fund, and throw in a growth fund. It feels like diversification, but when you look under the hood, 70% of your holdings are identical. Here's the fix. Pick one broad index ETF like VOO or VTI. Either one gives you instant diversification across every sector. The next mistake is where beginners lose big. By the way, if this video is helping you, please like and subscribe. It helps more people find practical money management tips like these. You see a tech ETF that doubled last year, so you jump in. But that hot streak already happened, and next year it might crash, while boring index funds keep climbing. Performance chasing kills long-term returns. The hot sector today is often tomorrow's loser. For instance, clean energy fund exploded in 2020, then collapsed right after. Here's why boring investing wins. VOO and VTI just track the market, without trying to guess which sector will win. You own a piece of everything, and over the long run, the market has consistently gone up. But even with the right ETF, this next habit destroys gains. Beginners often treat ETFs like a game, buying and selling based on headlines and gut feelings. But every trade costs you. Even if your broker charges 0 commissions, you're paying in 3 hidden ways. First, taxes. Sell-in triggers capital gains. Second, timing mistakes. You sell low in a panic and buy back high when you feel safe. Third, lost compounding time. Every day you're out of the market, you miss out on growth. Here's the fix. Buy and hold through the noise. The stock market has bad days, bad weeks, even bad years. But over decades, it always trends up. VOO and VTI have survived crashes and recessions, and they've come back stronger every time. So set it and forget it. You're building long-term wealth, not day trading. Here's the biggest mistake of all. Trying to time the market keeps you on the sidelines. You're waiting for the dip, for interest rates to drop, for the election. The reasons could be endless. Meanwhile, you're losing the most powerful force in investing, compounding time. The market doesn't care if you're ready. It's growing without you. Here's the fix. The best time to start was yesterday. The second best time to start is today. The difference between a good plan today and a perfect plan next year is thousands of dollars in lost growth. You don't need to become an investing expert or save up thousands of dollars. You just need to pick a low-cost ETF and start. But if you really want to maximize your investing, you need to earn more. Watch this video to 5x your income using 3 unwritten rules.